Hi, this is James Eng with Old Capital, and this month's March 2024 multifamily financing webinar, the theme is barbell. So I don't know if it's because last month was workout and this month is barbell, or I'm just going to the gym more these days. So barbell is the theme this year or this month, and really what we're going to cover is deals for sale, what we're seeing in the headlines and sort of the story behind the story. And then we're going to get into transaction data, like deals that actually closed and how they got financed, sort of where we are in the cycle from different sources, and then also looking at broker sort of transaction and debt recaps from sort of the last 12 months, and then also getting into what we're seeing on the financing side across all the different loan types. And so there's a lot, I don't know, there's probably 40 or 50 slides in this deck. If you want the deck, just like the video, share the video, and send me an email here at the bottom, jeng@oldcapitallending.com, and I can send you a PDF of the deck. And then we're going to also talk about transaction data specifically in Texas. But if you have a market that you're interested in, we can run sort of searches on that particular market, the larger markets throughout the nation. So send me an email if you want any of that as well. All right, so barbell. The reason I came up with that theme for this month was really, on the deals for sale that brokers have out, you really have these stabilized properties, right? So 93% occupied. It's got a loan assumption. It's fixed rate, so there's really no issue with the balance sheet right now. No reason to really go right now. So these sellers are not desperate to sell right now because they're well occupied. They've got fixed rate debt. They really have no incentive to go except to maybe have some liquidity. This deal might be doing okay, but other deals in their portfolio might have some challenges, or they just want to redeploy that money because they've owned the deal for 5, 6, 7, 15, 20 years already. So that's sort of on the top end, I would say, just sort of your stabilized A, B, and C across the board. But then we're also seeing distressed deals that come to market. This is a deal that sort of has been on the market, and the occupancy is below 90. It needs some rehab to bring it up. But a lot of the deals that are distressed are on the right-hand side of the slide, which you can't see. Like those are not really coming to market. And what's happening is either they're getting sold off market, or the lender is changing out sort of the GP on the deal. So a lot of deals are happening that are not coming to market on the distress side right now. And so that's sort of what's on email blasts and things like that. And now let's get into the headlines of what we're seeing out there. So, this is a deal down in Houston, a very large, it's probably 1,000 units in Houston that, the real deal is reporting that it's delinquent. Here's another deal in DFW where it got posted for foreclosure, two deals in East Fort Worth. Here's a deal that it was supposed to be a conversion from office to multi. That got foreclosed upon. And so you're seeing these deals that have been in distress maybe for 5, 6, 7 months. And then the lender finally says, well, if you stop paying me, I got to do something. And so they try to work out a deal, with the current owner. And if they can't work out a deal, then it goes to foreclosure. And that's what we're starting to see. So those deals were in Houston, Dallas, Fort Worth. Here's a deal in San Antonio. This deal was, let's see, 1979, so 76% occupied, got foreclosed upon. The prior owner had bought it in 22 when a lot of these bridge loans were done. Here's another one that GVA, also same deal, bought in 2022 with a bridge loan, and it's essentially coming due this month. And they just said, well, we can't refinance it, and we can't raise any more money to buy another rate cap. So, the lender's only option is really to foreclose at that point. So we're seeing, across the headlines, foreclosures, which is eventually is going to become this right-hand side of distress deal. So you've got the barbell effect of, A, B, C deals that are well occupied, not in distress, and then you've got the stuff that is going to distress, maybe because of the occupancy or maybe just the balance sheet of that property when they took it on. All right, so let's get into what we're seeing of deals that actually sold in DFW, sort of first quarter 2024. So we're recording this sort of mid-March, so not the entire quarter is not done, but this is what has sold so far. So you're seeing some of these deals that are not able to hit 90% occupy, so you can't do a Fannie Freddie loan, so they're having to do non-recourse bridge. This was an example, this Avanti deal, 85% occupied across the portfolio. That was non-recourse bridge. Some of the smaller deals are still getting done, 88 units, this recourse bank loan. But your stabilized deals, 93%, it's just still going Fannie Mae. And then assumptions are still getting done. If you have to do the non-recourse bridge, people are doing it at 76%. So DFW, I mean, a decent amount of transactions, but still, pretty light overall. Some of these deals, your A class stuff, people are still doing Fannie and Freddie on and loan assumptions. This deal down here, same thing, non-recourse bridge on 70% occupied property. So DFW, decent amount of transactions, sort of first quarter. Austin, pretty light, right? So Austin has probably the lowest rent growth or most negative rent growth right now, per a lot of different reports. So it is hard to underwrite deals there. Most of these deals went Fannie and Freddie, and I put also the term that these deals were done. So these investors coming in to buy these deals, they're not putting 10-year money right now. They're doing 5 and 7 year money, which nobody knows. But it might be a great idea because in 2 years or 3 years they refinance to a lower rate, or in 4 or 5 years when they go to sell, they don't have a big prepayment penalty. So that works to your favor. But if rates stay high and elevated for a while, then they maybe wish they had a 7 or 10 year loan at that point. So deals in Austin mostly this quarter have been Fannie and Freddie, 5 and 7 year money. This was a student housing deal. They used a non-recourse bridge. So I don't know exactly if Fannie and Freddie couldn't do it, or maybe there was just that was a business plan at the time. All right, so Houston had, I think, the most transactions. So they had a mix of everything from loan assumptions to 5 year Freddie. Some of these deals that are, and this one looks pretty much brand new, and lease up had to go bridge. This one's 23% occupied, non-recourse bridge. And this one was a part of a portfolio, this gray house. And if you don't recognize that name, Tillman, he actually, I think, owns the Rockets. So he bought an entire portfolio, and I didn't see any debt on it. So I guess he just paid cash for it. I'm not sure. Uh, but in terms of Houston, I mean, most of these very similar to Dallas Fort Worth. I would say just that some of these deals in Houston are having to deal with the higher insurance that Dallas is maybe 1,000 a door in insurance, but Houston is probably 1,500 to 2,000 a door on some of these deals if they're in a floodplain. All right. So San Antonio was pretty light, like Austin. Some Fannie Freddie loans were done, but then this was a property, this Summit Escalado. This one actually, I guess it was a transfer of ownership because the lender took it back. The loan was matured in December of 23, and the lender took it back. So we're starting to see these foreclosures come through, and if the borrower can't step up and put in additional capital, then the lenders are taking it back. So that was sort of the transaction data for Texas. Remember, if you have a market that you're looking into, send me an email and we can run it for deals that have sold in that market for sort of the first quarter of this year. All right, so this is the federal funds rate, and this is almost a reminder for me of, sometimes you got to go back and look at, all right, so when the Fed has paused, so they've paused since essentially last July, so it's been about 9 months. This was about 6 months, this was about 12 months, and we're sitting here at 9 months, and we're waiting to hear from the Fed. So this month here in March about, everybody's anticipating when they cut, but with inflation still a little bit higher than where they want it, they're sort of holding pat. So we're gonna have to wait and see where they cut. But you can see sort of either they sometimes they cut even before the actual recession started. And this is Ken McElroy. This was on a video that I snapshotted out that he felt sort of the top was, whether it's Q4 of 21, Q1 of 22, that was sort of the top. And now he feels like, we've gone down, let's say 20, 25%, depending on what class you're in. And then, February 2024, he puts us about right here, which is still a buyer's market. And you are still getting a discount. The question is, does the next year go down a little bit further and that allow you to get a better basis in the deal? But what we're seeing is, there might be more people bidding on deals, and that's going to sort of put a floor on this section and sort of have us come straight back out of it. And so this was Green Street, which tracks sort of valuations across the board. And, they said, look, since the peak, we're probably down, apartments are down about 30%. They're still seeing about 50 to 60 basis points in 2023 of expansion. And they're saying, these where the index is essentially back to 2018. So if you, let's say apartment index was 137 here, and then sort of 2018 was around the same time. So same place. So this goes back to Howard Marks and the market cycle. And I think reminding yourself of sort of where we sit sometimes, similar to that federal funds rate chart is, you have the rate cuts, which happened during COVID. It drops the risk-free rate to essentially zero. 10-year treasury is 1%, leads to more of this private lending, new construction development in 21 and 22. And now this is what we're seeing, right? So some of those decisions weren't great. There's a lot of money to be put out and easy to raise money. So you had foreclosures a little bit in 23. It looks like more in 24 are coming out. And then everyone's in fear right now. Money's tight. It's hard to raise money. And you might have some economic contraction. So this is what we're feeling right now. But it's going to lead to rate cuts and easy money and positive market development. So we have not seen this yet. So everybody seems to be waiting for this. If you're at NMHC in January, everyone seems to be talking about how many rate cuts are going to happen this year, but we haven't seen it yet. All right, so federal funds forecast. So nobody's expecting anything in March. Hopefully, I'm not proven wrong by the Fed this week. But then in May, everyone's saying, all right, they're going to stay pat. This is what the market's expecting. And then maybe a cut in June, and then maybe a cut in September. So maybe you get two, maybe you get three in that range in terms of probability. But we'll have to wait and see. Make sure no banks fail. Make sure unemployment doesn't go through the roof for some reason. And there's a challenge, right? So inflation is still high. And so that's allowing the Fed to sit sort of where they are before they hit the 2%. So, all right. So, we've gone through this, but, I think right here in terms of the oversupply, that's exactly where we are. We're starting to see concessions, negative rent growth, and then hopefully the building will stop. But right now, there's just a lot of multifamily units going up. And, Newmark put out a pretty good deck around, pros. That's I guess, positive, I guess what they call tailwinds for you airline pilots out there, and headwinds. And this is probably the biggest benefit to multifamily right now. It's just that, yes, everything, rents have gone up or they've essentially peaked or flattened out right here, but the price of home ownership keeps going up. So the price of houses keeps going up, and then this higher interest rate environment is making mortgages more difficult to get. So the spread, I mean, the spread is almost unheard of. So I guess we've typically seen maybe a $200 or $300 spread down here, but we're at 1,000. So I'm not sure how this corrects, whether multifamily can keep pushing rents, which it hasn't been because of the supply, or if single family comes down in terms of pricing and then also interest rates. But yeah, so I mean, you've seen a 42% increase on existing and 27% increase on new houses. So median price of a single family home is $400,000 right now across the US. But this is the part that is really impacting the entire market is the amount of new supply. They broke it down by quarter, but on a quarterly basis in 2024, it seems like every quarter is a new record. So the first 3 quarters of the year, you're getting up to close to 3% of the inventory growth or percentage of the inventory in the US, but in certain markets, I've seen it as high as 7 to 10%. And in those markets, it will be a challenge to push rents. And so thus rent growth is essentially zero. So this dotted dashed line right here is overall. You can see Dallas is about probably -2, Fort Worth -3, San Antonio -4, and then Austin, which is something that we typically don't see, but it's at -7% in rent growth right now because there's so much supply coming on in Austin. But throughout this sort of downturn, uh, the benefit that multifamily has had is that Fannie and Freddie are still lending, and they're taking a larger share of the market compared to where they were. So they were probably 40% the last 2 years, 21, 22, 23, they were up at 54%. But I mean, this chart probably says it all in terms of sales volume. It's from 305 to 119, so it's probably a 70% drop. And then it goes back to maybe 2014 that we saw that amount of volume trade. So just the gap between, like, we're talking about the barbell effect where people who are stabilized are still selling, but then if they don't get the price, they're just going to pull it back, right? So in 2023, we saw a lot of deals that went to market but didn't trade. So that's why this number is even lower. And then a lot of these distressed deals, yes, the lender might take the deal back, but it might not sell for a while. They might have to, invest more money into the deal or fix the deal before they're able to sell the property. So positive on the left-hand side is really just the rent versus cost of ownership. And then the negative is really just the new supply dragging down not only your occupancy, but then also impacting your rent growth right now. So just a quick background on myself. Born and raised in Houston, went to school at UT, been in DFW since 2006, and then was an underwriter for GE Capital through the last financial crisis and from 2007 to 2015. And then have really focused in on multifamily since 2015 as a lender, originating about 1.5 billion across 170 properties and invested in close to 40, 45 properties in all the major markets. So DFW, Austin, San Antonio, Houston. All right. So now let's talk about where sort of Fannie and Freddie bridge loans, bank loans are at in today's market. So bank loans, they're still getting done. They're at 8 to 9%, but this is the biggest thing. They are focused on existing relationships. And if you do not have existing relationship, they want you to create a new relationship by bringing deposits. So we're seeing, whether it's 5%, maybe 10% of the loan amount, they want to see in deposits that not only you show in your bank account, but they want you to move them over there to start that relationship. And these are usually smaller deals, probably 5 million and under, but they are able to get those deals done. Freddie Mac SBL is still very much in the market, and they're looking at probably 6.5 to 7 right now, just where 10-year Treasury is. And it allows you to lock the rate up front, but they are very quick in moving their rate. So if the 10-year Treasury moves, they're going to move right behind it. Freddie Mac conventional, still doing a lot of these, moving floating rates to fixed rates. And, Freddie Mac is still being pretty aggressive on their spreads. And so that allows you to get the rate hopefully in the high fives, sort of low sixes, depending on affordability and if you buy down the rate at all. But I think the last thing I read, they're doing a lot of 5 and 7-year paper, which is what we were seeing in the transaction data earlier across Texas is most people feel like these interest rates are high relative to what we've seen in the last 10 years. And so people just don't want to lock that in forever, forever being 10 years. So they're doing 5 and 7. Similar with Fannie Mae, same stuff, 5.5 to 6 on interest rates. but probably closer to 6 right now, just where 10-year is. And non-recourse bridge. So we did see non-recourse bridge lenders are still out there, and people are okay taking that. They buy the cap. Maybe a 2-year cap may cost you 5% of the loan amount. So you're paying the interest up front, but you're typically getting higher leverage than Fannie and Freddie. And a lot of people who are buying deals with non-recourse bridge, it's all about the basis, is what they're saying, because they're buying the deal essentially at the loan amount that the last guy had it at, or under the loan amount. Um, so all these deals, all these non-recourse bridges, eventually, sometimes they sit on the balance sheet of the lender, but then also a lot of them go into what's called CLOs. And so there was a report that came out sort of on Q4 data, and I thought it was, I mean, every line I read, I I wanted to talk about, but I tried to snapshot out the main points, and they hit it dead on. And peak issuance, 21, 22, which was the peak. They're hitting their maturity dates now, and to qualify for these extensions, it's usually some sort of debt yield hurdle, right? So you bought the deal, it was a 4% debt yield, and you were going to take it to an 8% debt yield, essentially doubling your NOI. But now, to qualify for the extension, you can't do that, right? So, or you're not hitting it because of, the rent growth's a little bit lower and your expenses are a little bit higher. And so the lender can waive these, hurdles to give you additional time to complete the business plan. But usually these lenders are looking for more equity, right? So principal pay down or replenishment of your interest reserve, CapEx reserve, and they're expecting a lot of volatility over the next 12 to 24 months. So whether all these different people can cut up the data a lot of different ways, but every place that you look, the delinquency is higher on these CLOs. And so uh, all these deals have to be recapitalized because of the higher interest rates, lower cash flows. And then it's really coming down to the borrower's ability to raise equity. And, this is, their opinion, Morningstar's opinion, and we're seeing it a little bit now. Syndicated equity is a great way to buy CRE, but it has shortcomings when additional capital is required, right? So if you have to go to one guy to get the money, it sometimes is easier because he's got, you know, 90% of the equity or 95% of the equity, and the GP's got 5 or 10%. But with syndicated equity, everyone put in 100,000, and now you're going back to them for $10,000 checks. They might just say, "No, I'm going to pass on this deal and let the GP figure it out." And so this additional capital for these deals is getting harder and harder on the syndicated equity. Lenders have tightened underwriting standards. Inflation has really pushed up payrolls, insurance, and taxes. And, the challenge right now is the plan was always to put in, 5, 10,000 a door, and you're going to get $100 to $200 more. But if the renters don't want them, they want a lower price point because they're scared of whether it's they're not getting the amount of income that they want, and they're sort of buckling down, and there's not any more free money coming from the helicopters that during COVID. So borrowers are finding that the return on the investment, so you put in 10,000, you might only get 50, has significantly declined, and they're scaling back those business plans. And another thing that they talked about was the lease up of newly built properties. The goal always is, well, the developer just gave away these units. They gave 3 months free. Now I'm going to come in, renew all these tenants, and there's going to be no concessions. But this report is saying, these concession losses have remained elevated for multiple years after even loan closing. And then in some of these properties, obviously, uh, more in C and less in A class, they're seeing an increase in credit loss, right? So whether that's fraud, whether that's people just not paying, and it's taking longer to get them out. But cap rates have increased, and then this just shows the amount of CLO issuance. So 62 billion in 21, 34 billion in 22, and then 6 in 23. So pretty much fell off a cliff in terms of the amount of deals that were debt funds that turned into CLOs compared to 21 versus this last year. All right, so to wrap up, so these were some of the deals that Old Capital closed in 2023. We did about 540 million, mostly Fannie Freddie. Fixed rate debt was majority of the deals that we did. People bring us in for a couple of reasons. I would say one is, representing you, the buyer, throughout making sure that you're choosing the right loan, making sure that your loan agreement is what they said it was at the beginning, and whether hosting you at our conference, at different podcasts, lunch and learns, walking deals with you, uh, that is part of what we do at Old Capital and helping you through these difficult situations that some of these investors are in right now. A couple events that we're having. We're having a bus tour, so we're doing a 1 day sort of in the classroom where we're going through a lot more in detail of similar to this webinar. And then the second day, we're going to go look at some properties that we financed and sort of tell you the inside story on those deals. And then later on in April, we are doing our charity event at the Chicken and Pickle, which is we're going to have a pickleball tournament. So we've got listing brokers, lenders, property managers, all people throughout DFW that really are part of the multifamily community here, and we're going to be raising money for a nonprofit called City House, which provides shelter for teenagers who are maybe going through some sort of abuse or homelessness in some way, to get them back on their feet. And then this is the big announcement. If you've come to our conference, we've hosted it for the last 7 years. October 9th and 10th, we are taking the presidential theme to the next level and hosting it at the Bush Presidential Library / Center Institute. And if you haven't been to our conference, this is one to come out. So put that on your calendar, October 9th and 10th to come out. There'll probably be 400 or 500 multifamily investors at that event. So thank you for watching. Definitely subscribe to the channel, like the video, comment on the video of what you're seeing out there. Any questions, any upcoming videos that you would like me to do. But if you need help with whether it's an upcoming loan maturity, term sheets on new deals, reviewing a deal, or just getting started, send me an email here at jeng@oldcapitallending.com, and I'm happy to go through it with you. And see you guys next month.